Okay, this is just a quick review of net working capital as versus cash flow. The two are related in the sense that changes in net working capital do impact. I'll zoom this in a little bit. Do impact cash flow, but they're different quantities. So let's go sort of just very back to basics. Balance sheet accounts versus income or cash flow statements or accounts. So a balance sheet is a point in time, a specific point in time. So let's say we have a balance sheet that has cash of 100. So this is the asset side. Cash of 100, accounts receivable. We're having a hard time writing today. Accounts receivable of 50, inventory of 75, and let's make it a simple balance sheet. So let's assume that's all their assets. So that's 225. Yep, I think. And over on the liability side, liability plus equity, they have accounts payable of, let's say, $80, debt of, let's just say they don't have much debt of $20, and equity, what the shareholders have contributed or reinvested from income. So that would be it'd be 125 of equity, and because balance sheets always have to balance, meaning the asset side has to equal the liability and equity side. So this is a balance sheet, and the key thing is this has to be a particular date. It's not a flow of funds over time or anything else. It's at close of business on one particular date, and let's just say December 31st, 2018. For example, this is a statement of how much cash was in the bank at that particular point in time, how much was owed the company from customers, accounts receivable at that particular time, how much inventory was on the shelf at that particular time, and so forth. So it's a specific point in time. A income statement or a cash flow statement, either one. Income statements, cash flow statements are sort of very similar, but just include or exclude different items. So let's just use the term cash flow statement for now. Cash flow statement is a flow of funds, or you could think of it as a change, funds over a specific time period. Usually a year or a quarter, could be, a month or even a week. That's pretty uncommon. Usually monthly for most businesses will do monthly statements of income and balance sheets. So for instance, the company has revenue of, let's say, and this has to be a range. So this is a particular date. This has to be a range. So let's say it's from 1/1/2018 to 12/31 2018. So that's a range. That's a 1 year range in this case. Let's say they had revenue of $200 cost of goods sold, so cost directly attributable to the product or service, product sold or service of, let's say, 150. So they have a gross margin, so that's the profit on, this is revenue directly related to their product or service. This is cost directly related to their product or service. And then they may have what's often called SG&A, selling, general, and administrative expense. So those are things like office staff, accountants, and stuff that typically are considered more or less fixed costs. In reality, almost no cost that's totally fixed. You can always reduce costs unless there's some regulatory or legal issue preventing you from doing that. But it's considered, at least over a short period of time, to be fixed. So let's say their SG&A, selling, general, administrative, was 20, so their profit is 30. So they made a profit of 30 over this 12-month period. At the end of that 12-month period, this is the balance of these particular accounts. Now so let's talk about net working capital. Net working capital is you're just taking out a subset of the balance sheet accounts. Normally you're thinking of short-term current assets, and liabilities. Current assets are assets that should be converted into cash within a year. And current liabilities, we'll call this long-term debt. Current liabilities are liabilities which come due. In other words, they have to be satisfied using cash within the next year. I've added long-term debt here because that implies, or I think it's presentation rules say if it's labeled long-term, it's not due within a year. And equity typically has no specific repayment date. So these are accounts that are due within a year. They're also considered operating accounts, meaning by operations, it means dealing with the day-to-day functioning of the business, making the product, selling the product or service. So in the case of accounts receivable, that's you've delivered a product, but you've billed the customer for it. They haven't paid you, so that's what the customer owes you. Inventory, of course, is what's on the shelf yet to be sold. Incidentally, pure service companies will not have any inventory. And accounts payable is where you've paid for materials or products that you are going to sell, but you haven't paid for them, so that's something you owe. So in this case, net working capital is these current operating assets less current operating liabilities. So 50 plus 75 is 125, in this case, minus 80. So that's net working capital in this scenario is 45 at this particular instance in time. Now, where cash flow and net working capital get related is the change in cash flow, change in net working capital from one point in time to another does impact your cash flow. So let's say this is profit, and we're assuming that's on a accrual basis, meaning it's not cash flow. It's when you sell the product, regardless of whether you've collected it or money or not, you recognize the revenue. Same thing, cost of goods sold, whether you've paid or not. Under accrual revenue, you recognize it when you sell the product. But as a business, most business people are as interested or more interested in cash flow. So let's say this is over this 1 year period, and this is the balance sheet at the end of the period. Well, let's say net working capital, I'll make a little subset here. Let's say at 1/1/18, and I'm not going to do the whole balance sheet, but let's say accounts receivable were instead of 50, they were 75. Inventory instead of 75 was 100, and accounts payable instead of 80 was 50. So the net working capital, it's just the difference, assets minus current operating assets minus current operating liabilities, so 175. Net working capital is 125 at a 1,118 versus 45 at, this is 12/31/18, a year later. Well, what this means is you essentially, net working capital is greater because the assets increased, or the asset, so net working capital actually decreased, over this period. You had on January 1, you had 125 in net working capital, and on 12/31/18 you had 45. Well, since it's a positive net value, meaning the assets are greater than the liabilities, that means you have a net asset. And assets require cash, generally speaking. You have to invest your cash to create an asset. So on the one hand, you could say, well, it looks like the company's doing worse if you just looked at net working capital because it declined, so it's an asset that declined. But on the infamous other hand, that means that you had to invest, you had some cash that was freed up. You essentially sold an asset. It's a net balance here, but you essentially reduced an asset which freed up cash, and thus it increased your cash flow. So in this case, net working capital started at 125, it ended at 45, so the difference in net working capital is 80, and it declined by 80. Change was from 125 to 45, but that increases cash flow. So we'd add that over here, change in net working capital, so it'd be 110 for cash flow. And now that's a little bit, you have to think about that a little. It's a little counterintuitive. You can say, well, this seems bad. Net working capital decreased over this period, and these two balance sheets cover, it's the beginning of that period and the ending of that period. You could say, well, isn't that bad that your asset decreased? Well, if this asset decreased, it means you had less cash invested in that asset. And that's why, folks, that's why it's considered an increase in cash flow. Now this, in normal terminology, I said these are operating accounts, meaning dealing with day-to-day sales of day-to-day sales of your product or service. This would be treated differently if you had invested cash in, say, like a factory, what's called a fixed asset, something that's going to last a very long time. Not these accounts, by definition, they're current, meaning they come and go within 1 year. If you invest in a factory, that's considered a capital expenditure and is not typically subtracted from cash flow. In some sort of ultimate sense, it is a cash. If you invest in a factory, it is it obviously impacts your cash balance, but accountants and business people tend to like to keep operating, meaning accounts that are dealing with day-to-day operations, sort of think of them separately from accounts or investments that have a very long life. Obviously, the dividing line between that's a little arbitrary. People typically pick a year, and most accounting rules, generally accepted accounting rules, say a year, but granted, that's sort of an arbitrary thing. But anyway, so big picture, net working capital, balance sheet accounts. So the net working capital is always expressed as a particular instance in time. Cash flow is over a period of time. And then the change in net working capital from the beginning of whatever cash flow period you're looking at to the end does impact the cash flow. It is a addition or subtraction in cash flow. Okay, hope that helps. Bye.